Good morning, everybody. Welcome to our university program. My name is Max Rosenthal, and I lead our education team here at Everhart. We are going to jump right into today's presentation, which is pre-tax versus Roth. I'm going to share my screen, and I will warn you, this is pretty technical. We're just going to get right into the weeds, and my goal is to just educate you on the mechanics of pre-tax versus Roth so that you can make an informed decision. I think the real goal with choosing between pre-tax and Roth, investing is just lowering your lifetime tax bill. And so that is my goal, is that you walk away knowing exactly how to essentially lower your tax bill throughout your lifetime. So let's dive in. And there will be Q&A at the end. So, if you have questions, certainly write them in the chat box. I'll pause at the end for any Q&A. You'll also have opportunity to connect with us really at your leisure. We'll share our contact information at the end. So quick disclaimer, I am not a CPA or tax advisor. Everyone's situation is unique and nuanced. So just proceed slowly, make sure you're consulting with professionals, and don't make any rash decisions. This can really add up over time. And just want to make that disclaimer. I am here to educate you and give you the tools and the kit to make the right choices. So I'm going to share really the letter of the law first, and then I'll break down our tax code, because it's really important to understand that when making this choice. And then last, I'll conclude with different strategies that you should consider when it comes to pre-tax and Roth. There are certainly other items to lower your tax bill that we could talk about, but today is just pre-tax versus Roth. So for visual learners, I like this slide. Basically, when you contribute via pre-tax, I think people understand this, is you're not paying tax on that income along the way. Every time you contribute, you are decreasing your taxable income for the year. Once you pull that money out, and most people are doing that in their retirement years, that triggers taxable income. So you don't pay taxes now, you pay taxes later whenever you're doing a pre-tax, or sometimes people call that a traditional contribution. Roth is essentially the opposite. So every time you contribute via Roth, you are triggering a tax bill. And when you pull that money out, as long as you've had the account for 5 years and you are at least 59 and a half years old, that money would be received completely tax-free. So in my opinion, this is a pretty big decision to make. Do you want to pay the taxes now, or do you want to pay the taxes later? That's the question you'd be asking yourself. So there are pre-tax and Roth options inside most of your 401ks if you have a 401k plan through your employer. There is also what's called an IRA, individual retirement account. So I wanted to highlight the differences between pre-tax and Roth inside of each type of account. So with the 401k, it's pretty basic. Same rules apply for the contributions and distributions, right? Pre-tax is a deduction on the way in, and you pay taxes on the way out. Roth is the opposite. I wanted to highlight here that when you contribute to a 401k, there is no income limit. So whether you make 30,000 of income for the year or $1 million, both people can contribute up to the limit inside their 401k. And this is a combined limit. So you might do some of your contribution as pre-tax, some of it as Roth, but the combined total cannot exceed 23,500. And this is for 2025. If you're 50 and older, there's what's called a catch-up contribution. And then uniquely this year, there's an extra catch-up for those age 60 to 63. So you can see the different limits for the different age groups there. IRA is a little bit more restrictive. So you'll notice for the income and the contribution limits, those are different. If you're going to contribute to a pre-tax IRA and you are a participant in an employer plan like a 401k or 403b, you might make too much money and not be eligible. So for married filing jointly, if you make over 143k, you cannot do a traditional IRA contribution. For single filers, it's 87,000 and above. If you're married, but you're not a participant in a 401k plan, the limit increases. So as long as you're below this 240 figure, you can contribute to a traditional IRA. The reason why there's like a range of income here is because it's sort of prorated. And once you exceed that top line, you can't contribute a dollar into the traditional IRA. So for Roth IRAs, the limit is a little bit higher. For married couples, it's that 230 to 240K range. For single filers, it's a little bit less. And then the contribution limit is much less. So for 401K, again, you can do a total of 23,500. IRA, it's only 7,000. And if you're 50 and older, you can do an extra 1,000 for a total of 8K. So that is kind of the letter of the law with pre-tax and Roth. You know, you might be subject to an income limit and there's contribution limits, but generally most people have access to do one or the other. So I want to break down the tax code, because if you don't understand this, you're not going to make a educated decision when you're contributing pre-tax or Roth. So anytime we generate income in this country, we will create a tax return for the following entities. I guess it depends where you live, but everybody would be due to pay a federal income tax. Some of you might pay a state income tax depending on where you live, and same with local governments. So just understanding how it works will allow you to make decisions to lower your tax bill. We don't owe any duty to pay more tax than necessary. So I would encourage everybody to understand the system to really mitigate your tax bill if possible. So this is how it works. Basically, you add up your sources of income, you subtract any what are called above the line adjustments. So this would be like a 401k or IRA pre-tax contribution. Some of you might, have student loan interest you can deduct. There's other things like HSAs and 529 plans, but they're, for today, the pre-tax IRA or 401k contribution is what you would deduct. And then you have what's called the standard deduction, or you itemize your deductions. So for 2025, married couples can use a 30,000 standard deduction. Single filers, it's 15,000. If you itemize your deductions, which you only do that if you're going to exceed the standard deduction, and the things that you'd itemize would be mortgage interest, state and local taxes, charitable donations, etc. So I'm trying not to get too lost in the weeds here. I want to keep it pretty high level, but just want to break this down so you know how it works. Once you go through those steps, that generates your taxable income. You would apply the proper tax bracket and then sub out any tax credits. So I'll give an example here before or after I show the brackets. So if you're a single filer, the first $11,925 you make gets taxed at 10%. So whether you make, $10,000 or $1 million for the year, the first 11,925 gets taxed at 10. Each additional dollar will start getting taxed at 12%. So, the calculation would be $1,192.50 plus 12% above 11,925. And that continues. So the more income you make, you find yourself paying an incrementally higher percentage. Married couples, it's basically double the rates. So you pay 10% on the first 23,850, and then that next tranche goes up to 96,000, so on and so forth. So let's just have an example here of a married couple filing jointly. Say they make 150 grand and they contribute 10,000 as a pre-tax contribution into their 401k. They're going to use the standard deduction to keep things simple. And let's say they have 2 kids. Let's run through their federal tax return. So starting at the top, you bring into your sources of income. So in their case, they just have $150,000 of salary. Now you apply the adjustments, which in their case is just the pre-tax 401k contribution. So that gives them $140,000 of adjusted gross income is the technical term. Now they're going to apply their standard deduction, and that leaves them with $110,000 of taxable income. So this is where you would apply that to the tax bracket. So let me actually go back. They're a married couple at $110,000. So that means they pay $11,157 plus 22% of the excess amount above $96,950. So, I already did the math for all of us. What that results in is a tax bill of $14,028. But that's before any tax credits are applied. So because they have 2 kids, they get the child tax credit, and that nets out $4,000 from their tax bill. Federally, they would pay $10,000 in tax for their $150,000 of income. So it's a pretty high level view of what a tax return looks like. My hope is that all of you have a decent understanding of that. But again, we need to start at the baseline to help you kind of know what decision to make with pre-tax and Roth. So if, understanding this is just really important. So now I want to do an apples to apples comparison. What I mean is I want to show what it looks like to save the same amount of money into pre-tax versus Roth over a period of time, and see what the net outcome is, net of any tax. Okay, so let's just say you make $100,000 and you contribute 10 grand into a pre-tax either 401k or IRA. So that leaves you with taxable income of 90,000, and this is purely hypothetical. Let's say you are at the 20% tax rate. So 20% of 90K is 18 grand. Technically, your take-home pay is 72,000. Well, let's see what happens when you do the same contribution, but via Roth. So 100 grand of salary, you contribute 10,000 bucks. You don't get a deduction, so now you're paying 20% on all of your 100 grand of income, and that's $20,000. So your take-home pay would be actually $80,000. Or sorry, 70,000. You net out the 100. You net out from 100K your $20,000 of tax and your $10,000 contribution. So via pre-tax, you're left with $2,000 extra in your pocket. And to make this an apples to apples comparison, we would essentially invest that extra $2,000. So I want to show you a 5-year example, someone who stays in the 20% bracket the whole way through. And because we're putting it into a 401k, we got to include some type of investment return. So I'm just using a 10% rate of return and a $10,000 contribution. So just bear with me as I walk through this model. Okay, so 5 years of contributing $10,000, and I'm going to start with Roth first. Okay, so in year 1, you contribute $10,000, and if you're at the 20% rate, that means you also paid $2,000 in tax. So that's a total of $12K that you have paid out. Well, after the second year, you have your original $10,000, and we're assuming 10% growth on that, so that's an extra 1,000, and you contribute another 10,000. So now in your Roth account, you end that year with $21,000. And then the same thing happens again. You apply 10% growth on 21,000. You're adding another $10,000, so you're at 33,000 in total in year 3, and you result with $61,000 after year 5. Because you're doing this via Roth, when you withdraw the money and you've done it for 5 years and you're at least 59 and a half years old, there is no tax bill. So you have a net outcome of $61,000. Along the way, you paid $2,000 in tax each year for each contribution. So now let's compare that to pre-tax, but to make this apples to apples, you'll notice I did the $10,000 of pre-tax contribution. Well, now you have $2,000 extra in your pocket, and to keep it similar, we're going to invest that. So in year 1, you have $10,000 in your pre-tax account, $2,000 in just a general investment account. After year 2, you have another $10,000 contribution plus the 10% growth and your original contribution, so it's $21,000. You essentially, after year 5, end up with the same amount, $61,051 in your pre-tax account as you would have via Roth. but you did this tax savings account along the way, and that essentially nets out your tax bill. So when you net out your tax bill, you're left with $61,051, the same as it would have been with Roth if you invested the difference the whole way, which makes it an apples to apples comparison. So the point I'm trying to illustrate here is if your tax rate stays the exact same every single year, it really doesn't matter what option you choose if you're saving the same amount of money. The main thing to look out for with pre-tax and Roth savings is your tax bracket. Are you in a lower bracket today than you will be in the future? Well, that would result in a very clear choice, and we'll talk about that here shortly. So I want to highlight a couple strategies you guys can use to fund either pre-tax or Roth, and then talk about what are the things you should look for depending on the tax bracket you currently find yourself in. So the first thing that, or one option I should say, is converting money from pre-tax to Roth. So you are allowed inside of IRAs and sometimes 401ks to convert a pre-tax account into Roth, or at least a portion of it. So most IRAs custodians allow this, and some 401k plans allow this. I would say most small companies don't. Bigger companies like Fortune 500 companies do often allow 401k Roth conversions. Now, the big thing with this is the amount converted will count towards taxable income. So don't do this flippantly. If you have 100 grand sitting in a 401k pre-tax account and you convert all of that, well, that might push you way up into a much higher tax bracket than you originally desired. Excuse my phone ringing there. So another option is called a backdoor Roth IRA contribution. I think people are pretty familiar with this term. It's very popular. Basically, what you do is you open a traditional IRA account. You first make sure there's a zero balance in that account and any other IRAs you might own, traditional IRAs. You would fund it, but you don't take the tax deduction. So it's a non-deductible contribution. And essentially, you immediately convert that over to a Roth IRA. So the reason why people use this is if they make too much income to contribute to the Roth IRA, you can use this backdoor method and you're qualified to get money into your Roth. So it's completely legal, very common. And again, the main thing to look out for if you're going to execute on this is if you have a traditional IRA or really any outstanding traditional IRA balance, make sure it's zeroed out. If you have a balance already in the IRA and then you try to do this backdoor method, you might cause some of your money to actually get taxed twice. So it's really important to ensure you have a zero balance first before doing a backdoor Roth IRA contribution. Next is called the mega backdoor Roth IRA contribution. So this is, again, getting more popular. I'm going to say most of you actually won't even have this as an option. It depends on your company's 401k plan if they allow this, and most don't, but I'm still going to teach it in case it is an option for you. So the mega backdoor Roth contribution is first doing what I just said, the backdoor IRA contribution. And again, you're only doing this if your income exceeds the limit. So that's the first step. The next step is funding your 401k Roth. And so depending on your age, you can do different amounts. If you're under the age of 50, it's $23,500. If you're 50 and older, it's $31,000, and age 60 to 63, it's $34,750. Next, this is not common, and this is why most people don't have this option. But technically, some 401k plans allow you to do what's called an after-tax portion into the plan. So this isn't actually Roth. This is technically called after-tax. And the total that you contribute is $70,000 under the age of 50, $77,500 if you're 50 and older, and $81,750 if you're 60 to 63. So Assuming if your company doesn't do any sort of match, then that means you can do a total of 46,500 if this after-tax portion is allowed. So what that results in, if you do the backdoor Roth IRA plus your normal Roth 401k contribution and this after-tax portion where you convert it, that results in these following totals. So for a person under the age of 50, the most they could possibly contribute if they have the resources allowed is 77,000 into a Roth, 85,500 for 50 and older, and almost 90K for those age 60 to 63. So that is a mega backdoor Roth contribution. So next, I'm gonna highlight what are the things you should do depending on the tax bracket that you currently find yourself in. And again, I'm just highlighting pre-tax and Roth. There are some other things you might consider to mitigate your tax bill. But if you're in the 10 or 12% bracket today, we think you should do Roth. It's very unlikely that the rest of your life, you're going to find yourself in a lower bracket. And so the point here is, hey, let's capture this low bracket and then let it grow tax-free and withdraw it. You know, we might find ourselves in the same bracket, but there's a decent chance we'll be in a higher bracket later if you're currently in the 10 or 12. You also would consider converting money. So I see this a lot with retirees. They retire, now they're living off Social Security. They only take out a little bit from their, IRAs or other investment accounts. And so they're actually in a much lower bracket than they used to be. And they convert to fill up the 10 and 12% bracket and capture that low bracket. So I want to highlight here that if you do that and you're retired, that could cause your Medicare premiums to increase. So definitely be sensitive, proceed slowly, think about how this affects everything before, converting any money. Next, I call this the gray zone. So if you're in the 22 or 24% bracket, you really can't make a bad choice. And this is where you really want to model out what your future tax bracket will be. So you could do pre-tax or Roth contributions. Both are good in this scenario. If you have maxed out your 401k and you're in the 22% bracket or higher, well, you're basically only going to have the option to do a Roth IRA. You won't be eligible to do a pre-tax IRA. So that's what I would fund if you're really trying to max out your contributions. You could convert money in the 22 or 24% bracket. In my experience, I've only done this with people when they just have a very sizable investment account, or they have a large inheritance coming in where their retirement income is just pushing them really into a high bracket. So most people don't convert in the 22 and 24% bracket, but again, something to consider at the least, depending on your situation. Again, I need to highlight that this would potentially cause your Medicare premiums to increase if you're over the age of 65. And last but not least, if you're in the 32% tax bracket or higher, it should be obvious, but you don't want to pay taxes in that bracket. That's super high. We want to avoid that like the plague if we can. So pre-tax as much as possible. Once you've maxed out your pre-tax 401k, you won't be eligible to do a pre-tax IRA. So in that case, you would, if you're funding, retirement accounts, it would be the backdoor Roth IRA contribution. So I broke down a lot of different tools and kind of spilled out the letter of the law. I think this is a really good visual for what most people's income and pre-tax Roth situation looks like. So a lot of people, when they start earning income, they're not making a lot. And so they find themselves in that 10 or 12% bracket. And as they age, they start making more money. And so they start out doing Roth contributions, capturing that low bracket. Once they find themselves in the 22 to 24% bracket, again, it's sort of that gray zone. They might split their contribution. They might change all of it to pre-tax. And if they ever find themselves getting above the 32% bracket, that's where you would want to dodge paying taxes, do pre-tax, wait until you're retired to pay taxes. And, again, it depends on what kind of investment balance you have and where your money is saved. But most people kind of have this dip in taxable income in their retirement years. So, Social Security is only partially taxable. Depending on what account you pull from, you might have additional tax from IRA distributions. And then as you get older, 73 and above, you might have what are called required minimum distributions, where you have to pay tax on some of your pre-tax accounts. So a lot of people have this dip in their taxable income, and just something to consider when you're making the decision now of how to save and invest your money. So I want to just add a couple things as we close here. When you invest into a 401k plan, most of the time, whether you have pre-tax money going in, Roth money, or an employer match, all of it gets lumped into one regarding how it's invested. So like if you have, 3 different mutual funds in your account, well, all the pre-tax money, all the Roth money, all the employer match will go into that same allocation. Some plans allow you to separate how each source is invested, but it's a detail that I think is worth knowing for those of you that are using your 401k. The 5-year rule, I mentioned this right out of the gate, but for Roth distributions to be tax-free, whether it's in a 401k or an IRA, the account has to satisfy a 5-year holding period. And what's, I would argue, unfortunate is that if you roll over from a 401k to an IRA, and that's the first time you have that account set up, the clock actually starts over. So my advice is, if you have 401k Roth monies going, I would open up a Roth IRA as well, just to start that 5-year clock and make sure you have that settled. Because most people, once they retire, they move their 401k monies into an IRA. You also have to be at least 59 and a half, or technically have passed away or become disabled, for the distributions to be tax-free. So if you don't satisfy these requirements, the earnings that you pull are going to be taxed, and the full amount will also be taxed. And then there's a 10% penalty as well. So if you're going to save via Roth, it's just really important to satisfy these requirements. So those are the main kind of miscellaneous items I wanted to mention. When it comes to mitigating your tax bill, Roth and pre-tax is just one choice you have. Certainly a popular choice, and something most people are thinking about and have already been doing for quite some time. But there's lots of other ways to save, on your tax bill. You can contribute to an HSA. Some of you, if you're like a sole business owner or have a small business, you could open up a cash balance plan to open up more pre-tax deferrals. And then some of you might save into a brokerage account. That's technically called a non-qualified account. And there's lots of things you could do there to kind of mitigate the capital gains tax inside of that account. ETFs, muni bonds, tax loss harvesting, just to name a few. 529 college plans allow you to get a tax deferral. And then most importantly, always be on the lookout for any tax credits. That's the most effective way to decrease your tax bill. But yeah, we're about half hour in. Hopefully that was, the material you were looking for in terms of understanding how the mechanics of pre-tax and Roth work. I will now open the floor for any questions. And I will note here, if you scan that QR code, it should bring you to my calendar link. So if you're sitting here like, man, this just doesn't make sense, or I just have no clue what's best for me, just reach out. I'll be happy to set up a time with you and talk about your individual situation. You also can just email our general line and ask basic questions. But that concludes the presentation, and I'll stay on the line here and answer any questions you guys have. So I see there's already a couple in the chat box. Let me read it first and make sure it's good to talk about. are pre-tax benefit deductions, medical, dental, et cetera, considered above the line deductions for adjusted gross income purposes? So if you're paying for benefits, medical or dental, I think that would be a below the line deduction, but I'm not actually sure. So something you'd probably want to ask a CPA. Someone asked, wouldn't you pay taxes on the money you invested outside of your 401k? I think they're asking in the example I gave, the money that I used to invest outside the account, I didn't apply a tax, just to keep it fair. But yes, technically, if you put that in like a brokerage account, the gain would have a 15% tax. And in that example, it'd net out like $100, $150. So wasn't material to the example. Someone asked, if you convert through a backdoor traditional IRA to a Roth IRA, is the maximum still $7,500 per year if over 50 years old? Yes, the maximum. Well, hold on. If you convert through a backdoor traditional IRA to a Roth IRA, so the amount you contribute is subject to that $7,000 or $8,000 max. But you can actually convert on top of that more if you want to. You can convert inside the 401k, or you can convert from IRAs. And I don't believe there's a limit to how much you convert. It's going to massively impact your tax bill. So I wouldn't necessarily encourage huge amounts of conversion. So those are all the questions so far. If you guys have more, again, please reach out. I'll stay on the line here for as long as people seem to be asking questions. But other than that, thank you so much for tuning in, and we'll see you next time. Let me read this question. The graph that shows which bracket corresponds to which strategy, is it the same for post-retirement conversion as to pre-retirement investment? In other words, does the graph apply to both pre and post-retirement? Yeah, it was just whether you are not retired or you are retired, if you find yourselves in those brackets, those were the general strategies that we recommended. So, if you're in the 10 or 12% bracket, whether you're working or retired, we would consider, converting into Roth to capture that low bracket. If you're in the 32% or higher, whether you're working or retired, we would not want to push money into Roth and trigger unnecessary tax. Awesome. Well, I see most people have signed off. Thank you so much, everybody that's still on here. Please shoot us an email or schedule a meeting with me if you want to talk further in more detail. Have a great rest of your day.